So what was the takeaway from last time? Why don't you guys look at your notes and tell me what stuck out to you? Melissa, can you give me a number between 10 and 13? 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Quint, give me something that stuck out from last time. Hopefully something stuck. Dig, process, find. You did so good on that test. I know you're absorbing some of the stuff we're talking in here.
Why the U.S. is a net borrower to the current account deficit.
Okay, so yeah, we learned about borrowing and lending and debtor nations and creditor nations. On the big global scene, it's kind of an accounting type thing. What somebody borrows is what somebody else lended. And if we're thinking about the rest of the world, we can start to categorize these things in terms of countries. And so we set up some international accounting and looked at what's called the balance of payments. And the sum of those items, from a debits equal credit standpoint, left us with all three having to sum to what? 0. So the good news, when the United States runs a current account deficit, which always seems to have this negative undertone, now you can tell your friends that, well, hey, did you know we have a capital account surplus? Right? So surplus sounds better, right? So if you run a current account deficit, that has to be balanced with something else. And that something else is the capital account. And so that means that other countries, other nations, are finding it beneficial to buy U.S. denominated financial assets. A large part of that are these U.S. government bonds. All right, Julian, you on anything in particular, or you on us here? Yeah, okay. Make sure it's just the notes. All right, so our first market we were looking at, we had a supply and demand framework. And we were looking at the quantity of dollars, but it was a special subset of dollars that we call the foreign exchange dollars. Money that's actually being used for importing or exporting. And what was being measured up here? What was the price of that money? The nominal exchange rate. So the exchange rate E, which is always some other currency that's being traded for it. So in the example we went through, we said, well, suppose that there's a certain amount of yen per dollar being used. I just heard on the radio this morning on NPR, they were talking about Japan. And I mentioned to you exchange rate risk, that's another risk that companies take on when they go global. And one of the ways that Toyota has hedged against that risk is by opening up plants in the places where the cars are ultimately going. So instead of building the Toyotas in Japan, shipping them over by slow barge to California somewhere and dumping them off, they're actually building them in California and Kentucky. This has been going on for a number of years. And so I think I also brought up that example when we looked at the difference between gross domestic product and gross national product, which was the old way of looking at things. So it's the dollar value of all final goods and services produced within the nation's boundaries over the course of 1 year. So the Japanese-owned Toyota plant that's in California and Kentucky, those Toyotas are being included in our calculation of gross domestic product. Now, the owner's money is ultimately flowing back over here to Japan, and they have to exchange it eventually into yen to buy whatever they want, whoever the owners of Toyota, which of course is a publicly traded company, so that can flow differently too, but the executives of Toyota and whoever else is on the payroll, there is some exchange rate risk, but not the big exchange rate risk, right? So if we're shipping a $30,000 Toyota over to California, all of the risk is embodied in the full price of the Toyota that's coming across. Whereas if we build the Toyota here, and if that car has I'm just making up some numbers, but $3,000 worth of profit, look at the exchange rate risk that's different now. Now we're taking a risk on $3,000 worth of profit coming back to the mainland, right? So it's a way to hedge some risk in the global marketplace.
So, I mean, what kind of happens when you've got a corporation that, is overseas, say in Japan, where isn't the yen's the currency in Japan, correct?
Mm-hmm.
Isn't it growing kind of, or it's actually like decreasing in strength versus the US dollar, right?
Well, and that's part of what we're going to talk about now is the movements of those exchange rates and what causes currencies to change in value. And that's what this particular news article was talking about, was that the yen has been depreciating in value, which would actually make it more attractive to possibly produce more here and export them across.
That's what they were saying.
Yeah, yep. So, yeah, some interesting dynamics to think about. So I just want to kind of redraw the picture that you guys should have in your notes. We had an exchange rate of 100 yen per dollar versus an exchange rate of 120 yen per dollar. And I can't remember, did that mean the dollar appreciated or depreciated? Appreciated. So one of the ways, or one of the reasons that we draw the graph this way that makes it kind of nice from a student learning perspective, because there is another way to do it that doesn't work out so hot, is the way we've expressed the exchange rate. Up means appreciate. So when this number gets bigger, it's appreciation. We didn't have to do it that way. We could have shown it the other way in terms of dollar per yen, and then it would have been kind of backwards. So just remember, it is okay the way we've got it drawn here, that if this goes up, it's appreciation of the currency that you're measuring here. All right, so let's look at these shifters a little more carefully. I just kind of arbitrarily drew one, but like we've had to do in the past for this next test, we need to know the things that shift supply and demand. Okay, and number one is the change in the rest of the world demand for U.S. exports. A change in the rest of the world, so this could be Japan, demand for U.S. exports. So if the rest of the world is wanting to buy Chryslers, right, an American-made car, not the Toyota, so there's an increase in demand for U.S. automobiles, what's going to happen with the currency? So suppose there's an increase in the demand for U.S. autos. And this is world demand. I probably should put this in terms of the import demand, export demand curve, but hopefully this is row demand, not just U.S. domestic demand. Could be that too, though. So if there's an increase in demand for U.S. exports, what's going to be your prediction on currency? Is that going to tend to appreciate the dollar or depreciate the dollar? Depreciate? Appreciate? Appreciate. Okay, why? Using supply and demand, tell me what's going on here. supply and demand in the foreign exchange market to support your thought that that would cause appreciation. Which demand curve shifts to the right? I just didn't hear you. Okay, why though?
Because the quantity of money available for exchange is higher, but there's more in general.
They have to get US dollars to buy all.
They have to get US dollars to buy the car. That's the intuition that I want you to get out of that. So if you want an American car, you can't pay with yen. They don't want your yen. That yen's not considered money. When we did our equation for US money, it wasn't US currency plus yen plus checking accounts, right? The yen is no good here in general. You got to swap it. So if you want to buy US goods, you need to buy US currency to buy those goods. There's like an extra link in the armor, an extra chink, I guess. I don't know if it's a chink or a link, but it's something. We're going to demand more currency to buy those cars. So this is going to shift to the right. And if we start off at 100 yen, you can see that that starts to put upward pressure on the dollar, on the exchange rate. So the US dollar is going to tend to appreciate when countries want to buy more of our goods. So an increase in the demand for our US exports leads to an increase in the demand for dollars in the foreign exchange market, and that leads to an increase in little e, which is appreciation of the dollar. And the key thing to remember is to follow the currency with the goods. So the key point is to follow and link the currency to the goods. From this example, we need US, or let's not even put the word we, the rest of the world, rho needs US dollars to buy the American car. Of course, the exact opposite is true. If there's a decrease in the demand for US goods, then the demand for dollars will fall in the foreign exchange market, causing the currency to depreciate in value. So it can move in both directions. All right, questions or comments on that one? Our next stop is in the financial sector. So here we're talking about the current account, the demand for US exports. Now we're going to look at the US interest rate differential. Let's write that out and talk about it. So a change in the United States interest rate differential. This one's kind of a mouthful. In the loanable funds market, what did we learn about people looking to place their money? What's true about the loanable funds market? What do they do when they're shopping around? If you're an American citizen looking for a place to park your hard-earned dollars and your savings that you've been saving up, are you just looking in the United States? No, you're free to roam the globe. So what you're going to do is compare, well, I want something safe. I heard Germany's got a good economy and a good government in place. About the only one over in Europe, by the way, that's doing okay right now. And so maybe I'll buy some German bonds instead of buying those US government bonds. Let me check out the interest rate. Let me see what the euro is trading at versus the American dollar. So they're going to do a little shopping. Capital's free to roam the globe. And that ties into this interest rate differential. So when you're shopping you're going to look at the difference between the U.S. interest rate and the foreign interest rate. Remember that little asterisk from chapter 15 when we did the international trade stuff? What did that mean? The foreign country. So the other country, the rest of the world. We're going to use that notation a little bit more in this chapter. So we've got the U.S. interest rate and we've got Rho's interest rate. And these are little i's, so it's the nominal interest rate. And if this difference changes, how could it get bigger? How could this expression, the interest rate differential, which is this little equation, how could that get bigger? What needs to happen? U.S. interest rate goes up, Rho's goes down. So there's two things that could possibly happen to make this thing go up or down for that matter. So if there's an increase in this differential for whatever reason, are U.S. denominated financial assets looking more attractive or less attractive to that investor? More attractive, right? So the rate of return is higher on those financial instruments, whatever they are, compared to the rest of the world, which means they're going to want to buy them. But when you go to buy that bond from Taylor, is she going to take euros? No. It's an American bond, right? So we need to, in order to buy U.S. financial assets, it's going to lead to an increase in the demand for dollars in the foreign exchange rate. So as the Chinese say, wow, the United States looks like a great place to buy. I'm going to buy some U.S. government bonds. They have to change their yuan in for some dollars. So that'll lead to an increase in the demand for dollars. And then appreciation or depreciation? Appreciation. We're moving the same direction here. So we're leading to an increase in the exchange rate or appreciation. I want to make one quick note on the that interest rate differential, that we got those two moving pieces. So note, when shopping, global investors will look at both I and I star. And so this one going down makes the, and this one staying constant, if this stays at 8% and this one goes from 6 to 4%, again, makes the United States look more attractive relative to what else could be purchased. So therefore, an increase in I or a decrease in I star make the U.S. financial asset more attractive. And they need dollars. They need dollars to buy it. Okay. Our last one deals with expectations. And I think I'll just squeeze it in here. Number 3 is expectations, an increase in the expected future value of the dollar. We'll use this notation a little bit more as we progress into the semester. Superscript E is expected future rate. So this is the interpretation of that little shorthand would be an increase in the expected future exchange rate. If people think the dollar is going to be stronger tomorrow, what are they going to do today? Buy it or sell it? Buy it, right? Buy low, sell high, the old American way to make money. So now we're treating dollars like any other asset that you buy. You buy a car, an old collector car, you're hoping you buy it today for $15,000, it's worth $20,000 down the road, right? You buy a stock, you buy Google stock at $100 a share, you hope that it climbs to $120 a share. Now what are you doing? You're just buying dollars, which sounds weird, but you're going to buy dollars and kind of hold on to those dollars. If you expect them to go up in value, then you can sell them for a profit later. Same thing. So an increase in the expected future exchange rate leads to an increase in the demand for dollars today, which interestingly enough leads to a increase in today's exchange rate. This is kind of what we call a self-fulfilling prophecy. So it's like, hey, I think dollars are going to go up in value, so I go out and buy dollars. My actions actually fulfill what I think is going to happen, right? So a self-fulfilling prophecy to some degree. The thing is, there's people on the other side, just like we have in Vegas, on who thinks Louisville's going to win the championship versus who's not. Some people think Louisville's going to win. Other people think Louisville's going to lose. Right? So on the other side of the spectrum, there's another currency speculator that thinks the U.S. currency is going to fall. And so they'll take that bet. And those two parties kind of battle it out, and that's where we come to some sort of equilibrium on a day-to-day basis of how many yen per dollar are being traded. Okay, so that is the demand side of life. Now, the strange thing about the currency market is that the supply shifters and the demand shifters are very similar in nature, depending on what you are at a given point in time. So the supply shifters are going to look awfully familiar to you. The first one's probably the most different because it's just a little bit of a twist. But this is a change in the demand for imports. So this is a U.S. demand for imports. All right, so are people wanting to get into dollars or dump dollars? So if there's an increase in the U.S. demand for imports, what's happening to the supply of dollars?
It's going down.
It's going down. So this leads to a decrease in supply. So a decrease in import demand leads to a decrease in the supply of dollars, leading to an increase in the exchange rate. So I switched it on you, by the way. I said, now a decrease in import demand. So if we are decreasing the amount of purchases we're making from the rest of the world, we're not going to supply as many dollars. Right? We're not going to supply as much as we used to be because we're not buying their currency anymore. That will tend to appreciate the US currency. Okay. And as you guys work through your homework, you're going to look at examples of imports and exports of whether it's the foreign country or the domestic country, and just kind of think in those terms. Number 2 is the interest rate differential. An increase in the interest rate differential leads to a decrease in the supply of dollars. Remember that this is the foreign exchange market. These are the people that are bringing dollars to the market to either do importing or exporting. And if US denominated assets look good, then people aren't going to supply as many dollars as they used to. They're just going to hang on to them, right? So the supply of US dollars decreases. And lastly, if there's an increase in the expected value of the dollar, that's going to lead to a decrease in the supply of dollars, causing some appreciation. In other words, all these shifters are related to each other. It just depends on if you are holding dollars or holding other currency, whether you're a supplier or a demander. You're kind of you're reacting to the same type of information in a different way. Let's just call it there, Michael. I'll take your question. We'll see you on Friday.